Hey Phil, man, back again. What's happening?
Back again, man. Looking fresh with the hat as well. Loving the merchandise, man.
Cheers, man. I thought we'd get something with the right brand for once.
Yeah, we need it. We need a coffee.
Yeah, 100%. When's the Harbour Mortgages coming in?
Yeah, we need to, man. We've got the shirts, but now I think we need the hats next, I think,
Yeah,
man. I think
yeah.
that's next.
I love it. I love the more casual approach for sure.
Yeah, yeah.
Now it's very good to join you again. And I know there's a lot of things happening, and I feel like,
Yesterday.
yeah, 100%, man. And I feel like we always come, and start having a discussion when there's like a big event. So last time
Mhm.
we had like that emergency podcast when we had that first rate cut since 2020. And today, like we originally planned this call to talk about, the equities versus property and where you can kind of diversify and what's, safer long term,
Yeah,
short term, whatever it may be. And it's
yeah.
crazy because it's kind of going to be like an emergency podcast, given what's happening in the stock market today.
Perfect coincidence. Yeah.
Yeah, it's crazy, man. So the main thing I want to talk about today is just give kind of our viewers an insight into stock market, equities versus property. Look
Yeah.
at both assets and understand, where people can get most of that return
Yeah.
according to, their risk appetite, how long they want to hold certain asset classes, and what's happening in both markets today. So let's jump into it. Basically, with the stock market right now, we are seeing, markets down 10%,
Yeah.
approximately 10% since all-time highs. And I obviously look at the financial side, with equities, US equities, which drive the global markets. And a lot of our buyers, a lot of our clients have always been asking about, diversifying stocks and is it, better to put money into the US market or tech stocks versus Australian property.
Yeah.
Now, we never advise on these things at all, but all we do is, I just give my 2 cents on what's happening. There's not financial advice by any means. But
Of course.
basically, since the stock market's declined 10%, we look at a lot of technicals in the background. So we always understand from a global market point of view, what is the most likely outcome, given everything we see from a technical standpoint, price points, and what's happening from the global economy.
Yeah.
And one thing that's very, very powerful in, understanding trading and just looking at chart analysis is trend lines. And
Mhm.
obviously, I'm looking at a very long-term view. So trend lines can be kind of analyzed in any time frame, 5 minutes, 10 minutes, 1 month, 2 months. But we've got trend lines on the Dow Jones going back to 1929. That's from the Great Depression top of the market. This trend line intersects between the 2000 market top, the dot-com bubble, and it just got hit last year as we
Mhm.
made all-time highs in the stock market. Since then,
Mhm.
we've seen the market correct. Every time the markets hit that trend line, the 100-year long trend line, we've seen at least
Yeah.
a 35% correction in the markets. The S&P obviously doesn't go back to 1929. It,
Yeah.
became live a few years later.
Mm.
But from the 2000 dot-com bubble into the 2022 one-year bear market into today, it's hit the trend line. And we've
Yeah.
seen declines. And obviously, technical analysis charting is just one piece of it. There's a lot of indicators and data points showcasing that we were witnessing the most overvalued market in history,
Yeah.
more overvalued than the 2000 dot-com bubble, and that was largely driven by like AI, tech stocks, and I'm sure people might have heard of the Magnificent Seven. So like
Yeah.
your Nvidia, your Google, Amazon, all of those kind of companies, Meta,
Yeah.
basically pushing the market higher. And that's where there's a lot of concentrated risk in the market. So just recently, I wanted to make a few kind of buyers aware that there are more risks in equities today than property due to those foundational reasons. And then obviously outside of just the pure technical data, what we're seeing, there's global risks in the economy. So we've seen now today, Donald Trump came out after the stock market closed, so US time, and he called it Liberation Day. And he's announced tariffs on
Yeah.
the pretty much most countries across the world. And for anyone who doesn't, don't really understand what tariffs are, they're just essentially a tax imposed by government that are a tax imposed on goods imported to countries. And they're used to basically boost domestic industries or raise revenue. So in this case, all Trump is basically trying to do is trying to boost, the US industrial output and make sure that those companies benefit from the manufacturing themselves. And
Mm.
when the tariffs are increased to this amount, historically we've also seen a sell-off because there becomes like a global trade war. And now you've got
Yeah.
all this uncertainty in the stock market.
Yeah.
And as a whole, since rates have decided to be cut, since tariffs have come on, global equity markets have been declining double digits. Property markets, especially in Australia, we're talking about the Australian market, they've only gone up.
Yeah.
And it goes down to supply and demand fundamentals and the fact that Australian property is not going to be impacted by these, uncertainties, just like the stock market is. I think
Yeah.
that's crucial.
Mm.
And one thing that we know is we can always look at, historical data to understand what might happen. So even in the 2008 recession, when we actually saw the market crash, that was the largest recession in our lifetime. The Australian property market only declined 10% as a whole.
Yeah.
And again, that was driven by your more unaffordable markets. For example, prices in the top 5%. It wasn't driven by the more affordable properties and the right locations, which we're buying for clients today.
Mm.
So have you seen like anything from your end, Phil? Like have people been talking about
Literally,
equities versus
yeah. Yeah, literally exactly what you just said, right? Like, so with the global markets, we see the Magnificent Seven, we're seeing all-time highs. But then when we take a deeper look, we're seeing these Magnificent Sevens would be considered overvalued to a lot of people.
Mm.
And then a good example is Nvidia. We're really banking on AI to take over, and it probably will. We're pretty confident in Nvidia, but they don't actually make money yet, right? So they actually are really overvalued, and that carries a lot of those bottom companies that are actually getting lifted up, right? And
Yeah,
the same thing was happening, as you said, with property, right? You'll see the upper market fall, right? But the day-to-day Australian's not feeling like those houses are any cheaper.
yeah,
So it's very, very different in terms of the supply and demand that you see with property and with shares. Another maybe less serious example is Tesla, right? Really crashing seriously just because of linking it to Elon Musk, right? And it's very emotional in that sense, where Tesla was a great company 6 months ago. Elon Musk does something people don't like. All of a sudden, Tesla's not that great. And then that can really affect and have a flow-on effect to other companies that really crash. And to your point with the tariffs, from what I can see, Donald Trump and across the board is looking really scared and comparatively to other markets. The Chinese EV market is basically decimating European cars and American cars. There's no real competition there unless they do something like tariffs. So it's really, really complicated to see who's going to really benefit or not, right? It's really important to kind of take a step back and see how you're really impacted, right? And we're never going to say don't buy shares, only buy property, because you really should have both, right? It
100%.
really is important to have both, right? And what I saw personally, working from the bank with approving loans a few years ago, just before COVID really took off and blew everything up, a lot of people were taking money out and wanting to buy shares. They weren't really as focused on property. That was what I was seeing the more common trend of. And now, as that time goes, all-time highs are hitting, right? People are waiting for a crash, and the crash isn't happening, and then a new all-time high will come, right? And then you'll see maybe a minor correction, another all-time high. There's just so much going on. And then when you're looking at property, it's just still just doing this. It's just still going up consistently, and it's not changing, right? We're not seeing any massive increases in supply. So there's nothing to say that this isn't going to keep happening because, right, well, the great thing about Australia is, gold hit an all-time high. And now a lot of industries with our mining is hitting all-time high with gold, and we're making a lot of money from minerals. And then maybe iron might not be as successful in Perth, right? But now because the market has been so diversified that it doesn't really matter. Whereas when we're looking at shares, it's so dependent on how the countries are actually doing as a whole, right? And for example, another thing I saw today was our meat export is going to cop a tariff to the US as well, because our meat is really, really high quality and relatively cheap compared to the world. We're really competitive in our meat industry,
Yeah,
right? So all these corrections are going to see it happening into property, right? And into shares. Whether you think that you're going to get a good deal with shares or with property, right? It's really kind of case by case, right?
yeah,
If you've got your property portfolio there and it is solid and you've got no shares, right? We definitely think that you should be thinking about that. And then the flip side is maybe with all these all-time highs, is it a time to kind of cash out and maybe get into property because that's going to be safer right now. So it
yeah.
is really kind of complicated and really specific to the person. So obviously it gets into financial advice for us saying buy this stock, buy that stock, and probably won't be best for you. Maybe it's too much and you rather just buy ETFs. That's really good too, right? And that can really
100%,
work
yeah.
as well.
It can get very confusing if you go buy this stock, buy that stock. Like you
Yeah,
spoke about Nvidia, for example. They
yeah,
were running on like 70% profit margins for their chips
yeah,
like the last two
yeah,
years. But now
yeah,
there's so much competition in the market.
yeah,
Everyone is looking to get into the AI space and dominate that space because we all know that's going to be the future.
yeah,
And you
yeah,
saw what happened when DeepSeek came across and
yeah,
launched their product in the market. The AI market has tanked and hasn't recovered since because
yeah.
we know that those margins are going to decline significantly.
Mm,
Tesla, like you mentioned, a really good point about Tesla. Like there's so many factors into just one company or one stock or one
mm.
person that can become, major risks to holding this asset long term. People are rebranding the Tesla cars today. because they don't
Yeah.
want to be associated with Elon Musk.
Yeah.
It's gone
Yeah.
that ridiculous. It's gone that crazy in the market.
Yeah.
So
Have you
there's
seen the one saying,
obviously
sorry, I didn't know he was crazy or something with
yeah.
wallet? I've seen that
So
sticker. That's pretty
I've seen like
funny.
customized like Toyota logos put on like Hyundai logos. It's
Yeah,
crazy.
yeah,
But
yeah,
when that happens, there's all these factors kind of preventing you from being confident in the stock once you already invested, and you will sell. You might take a loss, and then that's
yeah,
where it all comes down to if you're going into the stock market, you're really going to be exposed to so many different factors. Whereas Australian property, you've got all the fundamentals supporting you. That's very
mm,
crucial. And one thing
mm,
I find not a lot of people think about is just power of leverage.
yeah,
So in
yeah,
stocks, yeah, you can leverage yourself. You can go on trading platforms and go 100x leverage, but it's more likely you'll get blown out and lose all your money. Whereas in
yeah,
property, you're not going to lose all your money going leverage and
yeah,
buying an asset because long term it will grow. Whereas we've seen
mm,
stocks go to zero in the past. And
mm,
it's just
mm,
insane to me that people like are still kind of, looking at equities as a more safer play when in reality it's not true. Just because,
mm,
they get FOMO. Like we actually have like a few real life examples. Like, I was talking to a client, a potential client, December last year, just after Trump came into power. And the whole market sentiment was all about, Trump's come in, it's going to be great for business. And these are at all-time highs in the markets as well. The markets are
yeah,
going to go soaring. So people
yeah,
ignore the fundamentals, how overbought everything is, how overvalued everything is, to your point. And then it's all about, the next leg up is going to be amazing. There's going to be, a generational market boom coming in, not based on anything but Trump. So
mm,
we can't just look at a market and think about, one person dictating what a stock market's going to do. Because ultimately, when Trump comes into power, everything he does is out of your control. If you look at the data, look at the technicals, that's what you should be following. So they
yeah,
were basically not looking to buy Australian property, and they were
mm,
buying Bitcoin above like $100,000.
mm,
So I'm not saying long term they're not going to make money on that trade, whatever it may be, but the market sentiment was so greedy at that time.
yeah,
Everyone was just chasing, 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 trying to get in, and ignoring all the risks in the
mm,
market based
yeah,
on one figurehead. I personally think what Trump's done with tariffs is great for America in the long run. I think it's going to create a lot of volatility and kind of disruption in the short term time frame, like we're
yeah,
seeing today. But in general, long term, he's actually reducing taxes, so people will be earning more, and then they will be generating revenue out of other companies overseas. So I
yeah.
think long term it will be fine for them, but overall, like the
Oh,
greed in the
sorry about that.
market for equities was just crazy.
Yeah, yeah. Sorry
Last
about
year.
that. Got a call, man. I'm a very important guy. I just canceled that.
No, that's
Uh,
fine.
Yeah, but no, you're totally right. And to say that with the Bitcoin thing, right? And as you said, that client made money. So we're not saying don't do that, right? They did
Yeah,
make money, and if they timed it well and sold well, right, they could have made a great profit, right?
yeah,
Because you did see that recent drop in Bitcoin,
yeah.
and then maybe you can use that to buy property, right? The reason why you really should be thinking of both is I kind of understand the sentiment of what you said of people saying they might get a better return on shares, like if you pick the right stock, but how many people are really picking the right stock, right? And for companies that are promising a lot of things that could not come into fruition. And sometimes
Mm,
these promises are actually factored into the price,
yeah,
right? Like we understand, and Nvidia is just an easy example of a company that's really valued and has a lot of potential. And I do think it is going to reach that potential, right? But what if a deep sea comes, or what if another company comes and they end up finding something and it's really disruptive to the market? Like Apple is a good example where I'm feeling like Apple's innovation and dominance, it's really starting to spread out,
mm,
right? And if they don't get that new innovation, they might have their value of their shares drop dramatically as well, right? If they don't get that new iPad, or if Samsung comes out with a new thing, right? Whereas with a property, you know this is going to be rented. And one thing I always try to tell people is see if you can get something you add value to, right?
yeah,
If you've got a big block, right? You maybe put 10, 15 grand into it, all of a sudden the values increase by way more than that, maybe even wait down the line and maybe even turn it into a duplex, and then that will flip even more, right? And then you've got a guaranteed asset that you can touch, right?
mm,
And you can leverage yourself to what you can actually afford where it's predictable,
yeah,
right? Like if you leverage yourself in shares, it can go right. We're not saying it can't, but when that risk comes, and where you're going to get that money to kind of get out of it if something does go wrong.
yeah,
Whereas
100%.
property, it's as guaranteed as it could potentially be.
Yeah, especially long run. Property
Yeah.
is not going to ever go down to zero.
Yeah, yeah. And
Yeah,
the supply factor too, right? We're not
yeah,
building enough, right?
yeah, of
Everyone
course.
wants to live in this country. It's a great
Yeah,
country, right? And what I've seen as well, and maybe it's a good point, a side note to maybe even ask you, is recently they actually even changed for foreign buyers actually being able to invest in the
Mhm.
country for
Yeah,
actual houses, but they're actually going to be buying apartments now, well, allowed to buy apartments now,
yeah.
right? So that could be a factor where we could see different types of asset classes that might not have performed as well previously that
Mhm.
could perform really well now as well.
Yeah, I think apartments will definitely catch up to houses in a lot of the states because there's a
Mm.
massive price delta for
Yeah,
sure. We personally don't like buying apartments for clients for
yeah,
investment just
yeah,
because of the fact that you don't have the land value there and there's
yeah.
theoretically infinite supply in the market. I
Yes, yeah,
think those kind of rules for foreign investors were put into place to kind of boost, off the plan,
yeah,
especially
yeah,
because
yeah.
the cost to build an apartment went up like 70% since COVID.
Mm. There
So
you go.
when you have such like a difficult time making all the numbers stack up if you're a developer, you want more buyers to pay a higher price
Mm.
point. And overseas buyers have money and they might not be, looking to buy an apartment unless they're stopped. There's a, kind of limitation for them buying a house, then they have to go to the apartment to invest in Australia.
Exactly.
So I think
Yeah.
that's basically the theory behind those rules for overseas buyers. And I think
Mm.
that's why you've had seen, apartments have more demand potentially from overseas. But even internally in Australia, a lot of people are buying apartments in certain locations now. I've seen unit prices are skyrocketing, especially
Mm.
where there's more than like a 50% delta between unit and house prices. So
Yeah.
I think they will perform well, especially in the short term, but
Yeah.
it's just not something we would like to expose ourselves to for the long term for clients because ultimately more apartment supply has to come onto the market given the historical supply crisis we're seeing.
Yeah. Yeah.
Over time, imagine you buy an apartment today, you might be performing really well, but then 5 years
Yeah.
down the track, hundreds of apartments come onto the market. What does that do for your growth?
Yeah. Yeah.
So
Yeah.
that's the main thing. I think long term you do really well in an apartment if you buy in like a strong location. So if it's near the beach somewhere, you can't duplicate, that the kind of presence where the apartment is located, the
That's
lifestyle
what I'm saying.
factors, those kind of things, that will really help you get that additional value. So like if you bought an apartment in Bondi, for example, I
Mm.
don't think that will lose value.
Yeah. Yeah.
Because no
Yeah.
matter what supply comes into Bondi, it's Bondi Beach. It's
Yeah.
world famous. People want to live there, and there's a very high premium to, have that view, for example, or whatever it may be. So those are the kind of reasons I would justify buying an apartment, but not just blindly go buy anywhere for sure.
And that's a great thing, right? Because you've got all these reasons why you've done that. Whereas with
Yeah,
shares, it's more or less it's an
yeah,
opinion that you think you're right about,
yeah,
which you can be and you can't be, right? Whereas one tariff or one change in one market can, or even a natural disaster can have a devastating effect on one economy or not another.
correct. Yeah,
And then, as you're saying with the property, right? There's only one Bondi. There's only one East Coast. There's only one West Coast. There's only one ocean around us,
yeah, yeah.
right? So we can't make more of them. Whereas when you're getting the supply factor with apartments, you're right. It can just be endless.
Yeah, 100%. And I think the share market, the compared to the property market, there's a lot of FOMO. There's a lot of
Yeah.
people, seeing, they check the charts every day, they check the price
Yeah.
points, and things got 50%, 100% higher overnight. And that's where all this FOMO is created.
Mm.
And I think
Mm.
that's where you get a lot of buyers ultimately chasing the stock market over looking the foundational growth factors for property.
100%.
And that's
Yeah.
where you can be a risk. So I think
Yeah.
today was just mainly to make and help educate people why that equity share market might be a bit more risky than you actually think it is.
Mm.
And over time, it has corrected and corrected deeply, and people have lost a lot of money there.
Yeah.
Whereas you won't see the same losses if, for example, if you put $50,000 into property market today or 100 grand to property market today, you're number one leveraging that amount of money to an asset worth five, six times, that amount. And on top of that, the property is not going to go to zero. The
Yeah.
property is not going to see like a 50% correction.
Yeah. Yeah.
And
Agree.
that's pretty much guaranteed in the market.
Yeah.
And that's something where, if you just look at that risk factor alone, you're eliminating, 90% of the risk in the market. And then to your point, we've got no supply. We've got such a strong growth foundation for property. You can really see long-term growth and you can sleep.
And yeah, and to say that, right, no one's really, if they can, going to sell their property at a loss,
Yeah.
right? If
Yeah.
your mortgage is higher than your property, you're basically going to hold that asset and you're basically going to keep that asset value high just because there's no supply. So it's
Yeah.
kind of like protecting itself in a way.
Correct.
And banks know this, right? Banks aren't going to do this and give you so much leverage on a property where they know they can't get their money back. Whereas with shares, there's a lot more of that risk factor involved where, leveraging is obviously really risky, but you do see those gains with people and you do get FOMO. But
Yeah,
with the property, it's easier to plan and protect yourself. And I always say, I kind of treat it like gambling, right? Just put in what you can lose. If you can put
yeah,
it into the market and you can afford to just never see it again,
yeah.
then we definitely think that you should be looking into it. And in the same way that you would buy a property and do all the research on property, you should definitely seek a professional to see where you should put your money as well.
Yeah, 100%, man. And I think one thing just on that, like people would never want to sell their property at a loss. I definitely agree with that. But I think, let's say, for example, you see there's a massive recession, a global recession as a worst case scenario. And the US stock market, as we know, drives, other country stock markets as well. That's the ultimate driving factor. So if US has a recession, we'll see markets across the world crash from an equity
Yes.
perspective.
Yep.
Last time we saw this, that will impact people's super balance for sure.
Yeah.
It does impact your wealth. It could impact the employment for sure,
Mm.
because a lot of people might be hired by US companies or global companies, and they might be laying off due to a recession. And then if unemployment spikes, people might not be able to pay their mortgages.
Yeah.
And this is a factor we've continuously kind of highlighted to our network and our clients since last year, because there's been a lot of economic risks globally. So if there is a recession, you're not going to see every property impacted. That's going to be very crucial to understand. We look at a lot of affordability data metrics. The clients that we work with are primarily investors, and we buy the more affordable properties. So
Mm.
in worst case scenario, a global recession comes into play, it's very unlikely we see those price points correct severely. They could be impacted. They could go red, 2, 3%, 5%, but I don't see them having 20, 30, 40, 50% declines like the stock market for sure.
Right.
And that's something
Yeah.
you can just hold it through because you've got a strong yield coming from a rental
Yeah.
perspective. And at the same
How would
time,
you? Yeah.
yeah, my main risk is, man, just property is worth more than $2 million. That's what
Mm.
the risk is today,
Yeah.
because
I agree.
that they're going to have the more unaffordable, levels. So people are depending on their bank loans and their mortgages and their jobs to pay off those mortgages for those
Mm.
more unaffordable properties, and things
Mm.
happens to their employment. Suddenly, they can't pay off the mortgage and they're going to distress selling. Then you see a
Mm. Mm.
waterfall effect and prices decline.
Mm. And you always do your due diligence, right?
Yeah,
Like when I've seen a lot of places outside of metro locations where you've seen their prices. If you look at a chart over the last 20, 30 years, it actually has done that, where it has
yeah,
actually jumped and deeply. You don't see that in capitals, but you do see it in those regional places where
yeah,
sometimes someone might feel like they're outpriced and they'll just take the risk on the regional places.
yeah,
But as you said, there's still risks in that too, because you do need
100%.
to be
Yeah,
careful with the
yeah,
reason why it's gone up in price. What's
correct.
pushing this demand?
Yeah, we see that in very regional towns. So like populations of less than 5,000 people, which we don't
Yeah.
touch. And we
Yeah.
also see that in blue chip. So
Mm.
Mossman, Hunters Hill,
Yep,
Vaucluse,
yep,
they're so unaffordable and driven by the luxury market. They have 5 to 10% swings every year.
yeah,
No one
yeah,
realizes because there's such a high price point, no one's really exposed to those markets, but it happens all the time.
yeah.
But again, those are the markets that are going to be most at risk if
Mm,
any global recession was to happen, unemployment spikes. That's why, again, we are very focused on affordability factors for clients.
yeah, yeah. And
Yeah,
even as an investor, those places aren't really as attractive, right? That's a
no,
type of own odd location
correct.
where
Yeah,
it's really up to the person what they feel like paying for it, right? If your taste might not be someone else's taste, even though it's really expensive.
yeah, that's right. It's purely a luxury market, unoccupied. Again, like that's one market. It's not going to,
Mm,
drive the entire
exactly.
Australian market, but it does
Yeah.
impact median price points and things of that nature as well.
Yeah, no, exactly,
Yeah.
exactly. And how much do you think that the stock market right now is really artificially inflated by governments? Because I know, for example, basically all the new jobs are basically government jobs in Australia, right? And a lot of these companies are doing okay just because countries aren't falling apart, basically, right? Because the economy is getting propped up artificially, it feels.
Yeah, that's a very good question, man. Honestly, since COVID, more than 80% of the today's money was printed.
Yeah, I've heard that. I've heard that.
I think if you look at the stock market, it's a very different beast because a lot of that money went into obviously asset classes, property, stocks, whatever it may be. I think the main risk is it's algorithm driven today.
Yeah.
So since 2023 end, the US stock market introduced 0 days option expiries. So
Mm,
basically, this allows algorithms to kind of have options expiring the same trading day. So they were
mm,
really manipulating the market, in my opinion.
mm,
The
mm,
volume throughout end of 2023 and the whole of 2024 was some of the lowest volume we ever seen, which means not a lot of human activity was trading the market. very
Mm.
algorithm-driven trading. And that's where you saw prices floating up, new all-time high, new all-time high. Volume
Yeah.
really spiked when Trump came into power, and we saw a lot of buying based on, hey, Trump's in power, great for business, and we saw like heavy buying, and then we saw what happened. Kind of had one more major high, hit that, and then it's been selling off since. And the
Mm.
volume on this last 10% correction has been incredibly strong,
Yeah.
meaning people
Yeah.
are getting out of the market. So I think look at these indicators like volume, look at things like RSI and MACD and all those kind of technicals and educate yourself and look at the fundamentals on top to really
Mm.
understand the risks of what you're doing. There's a
Mm.
really interesting technical indicator we look at. It's called a MACD. So basically, I won't go too much into it, but if you look at it in a monthly chart, so you can again look at different time frames, but if you look at a monthly chart, every time the MACD has kind of rolled over into what they call a sell signal, it's only happened 3 times for the S&P 500. So if I look at just the last data on this one, I'll pull it up on my phone because I was looking at it this morning. So the
Okay.
last 3 times it happened, January 2022, the S&P 500 declined another 27%.
Mm.
Before that, October 2018, S&P 500 declined another 20%. And March 2000 dot-com bubble, S&P 500 declined 35.5%.
Mm. Mm.
So just educate yourself and
Yeah.
understand where the risk might be.
Yeah, yeah. And also another thing I think about is, try to think of what industries you think are going to be
Yeah,
successful, right?
yeah,
So for example, during the last drop, one thing that exploded was Afterpay, right?
yeah,
Because people were falling behind. One was crashing, was cruise lines. People aren't taking cruises. These are very emotional things that people even think about.
yeah.
And even the emotion you can still win just based on emotion because the
Mhm.
perfect example that you used about, Donald Trump and everything getting boosted up. I had clients saying they don't want to enter the property market yet because they want to see what's going to happen with Trump and they're going to
Yeah,
see how the US economy performs, and then they'll be able to judge whether they can take money out and then buy property or just keep funding that and seeing where that goes. So
correct.
and
Yeah,
a lot of people do have that mindset and do have that thought. So you need to be aware that these are what people are thinking and doing. And
yeah,
as you said, educate yourself, just be in the loop. You don't need to spend hours a day in research,
yeah,
but you need
100%. Yeah.
to understand where the market is.
Correct, Ben. And I think you're definitely right. Like different cycles, different industries, different, markets or different cycles for sure. But if you look, for example, if you're looking at the cruise line sector or like Nike or like sportswear, whatever it may
Yep.
be, AI, you still have to look at the technical from a price point perspective to ensure you're
Yeah.
not buying at the top. That's
Yeah.
something we're doing with our clients on property today. It's very
It's the
important
same
not to
thing.
buy at the top of a
Yeah.
cycle as well, because you
Yeah.
could be holding that asset for 10, 15 years before it makes a new nominal high. And so you're not
Mm.
really making money. So
Yeah.
you just need to understand the whole picture. And obviously, from a property perspective, we can guide you, we can help you, and your team is there to help, facilitate that process. But overall, to your point, educate yourself. But always understand in the stock market, there's always a lot more risk than buying property, especially when it
Yeah.
comes to Australian property.
Yeah, and it's all relative as well, right? Like when you see that and you compare it, if property prices in Melbourne, for example, haven't jumped and everything else has jumped up double, then maybe Melbourne is something to add into your portfolio if you've already got
Yeah,
other things. Or if you're looking at the stocks as well, right, where you're seeing a big influx of one particular industry, then you're kind of going to be skeptical. Well, even though that industry is going to go up, is it at the bottom right now?
yeah.
It's easy to say, but even with property, it's the same way. You want to buy it in a market that's at the bottom, not just a cheap one as well.
100%, man. And that's
Yeah.
again, psychoanalysis, understanding what's
Yeah.
happening, what assets will grow. And my
Yeah.
2 cents in this inflationary environment, hard intrinsic assets will succeed long term.
Yeah.
I think
Yeah.
property will do really well. I'm personally keeping an eye on gold and silver. I think
Yeah.
gold will have a correction, and so will have silver will have a correction with this next stock market, kind of wherever the correction ends.
Mm.
But I would love to pick up those assets long term. I'm
Yeah.
also very bullish on Bitcoin long term. And
Mm.
again, it's all about diversifying and what we think is going to make sense, but always looking at what prices also make sense.
Mm.
And you want to see
Yeah.
those returns. Yeah.
Yeah, and if you can afford it, go for it. And I'll tell you a crazy story. In actually Sydney, they have this company called ABC Bullion that will sell you physical minerals like
Yeah.
gold, platinum, whatever. I walked past in the meeting once when I was seeing a client, and they had a line outside the store of people
Yeah.
buying gold. And I walked past it twice, and they were just churning people
Turning. Yeah. Yeah.
non-stop, right? You can go there, buy physical gold, and it's a great investment, right? And you've got something
100%.
intrinsic in your hand that you
Mm.
could maybe take back in a year's time and maybe pull out 20,000 or 20% more. You
Correct.
never know.
And that's why I always say in inflationary markets, people will want to buy property
Yeah.
because the value of their savings and the dollar is declining.
Yeah.
They
Yeah.
need to
And
put
it's
it
really
towards something
to touch
safe.
it. Yeah,
Yeah.
exactly.
100%,
Exactly,
man.
man.
Man, such an
Exactly.
interesting topic and got some
Awesome, man.
great golden nuggets again for the community. Thanks,
Go
man.
forever, man.
Appreciate
We
it.
can go forever.
We'll catch up soon. I know we can go forever on this stuff, yeah. But like, yeah, gold nuggets, intrinsic assets, gold, silver, Bitcoin, property for sure.
Buy everything, shares
Buy
and property.
everything.
Just
Yeah.
one.
But one thing about that, when you buy everything, use something called dollar cost averaging. Same to do
Yeah.
with property. Like, don't spend all your money on one asset at one time. You can kind
Yeah.
of, diversify and make sure you're kind of allocating your proportion of your fund as the price may keep dropping. It'll
Mm.
give you more exposure to something and less risk over time.
And also the cost to you, right? Like if
Yeah.
you're really good at your profession and this isn't really your thing, you'll make more money paying someone else that knows what to
Yeah,
do, and
100%.
you can
Yeah.
even
Seek
make more
advice.
money with the profession.
100%. We'll be
Yeah.
ready for these volatile times, Phil, and I'm sure we'll
Yeah.
be catching up multiple times on these stocks.
Yeah. Let's hope
Cheers,
so,
man.
man.
Very good catching up, man. We'll speak soon.
Good to see you, man. Good to see you.
See you, man.